Corporate finance practice problem using OneNote. Expected value for multiple years and net present value calculation. Get ready. It's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side. We're in the Practice Problems tab. We're down in the 1331 Expected Value for Multiple Years and NPV tab. Also note, when using OneNote, look at the Immersive Reader tool. Many of our presentations up top will be mirrored in the text area. Same name, same number, but with transcripts down here, transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, information up top. We're going to go through the calculations on down below. We're going to continue on with the idea of a capital budgeting type of process here and our idea of trying to organize our data in this kind of statistical type of way so that we can make a good judgment into the future, a way to organize our thoughts as we make our projections. So the typical capital project, you'll recall, will typically include an outflow up front, money going out so that we have benefits in future years, typically then having an impact in future years. The primary tools that we usually use to calculate them are the present value tools of the net present value and the internal rate of return. We focused in a lot on those calculations in prior presentations. Now, and so you can go back there if you want to focus in on that. Now we're going to add the added detail of this type of analysis for this percentage type of analysis to make projections into the future. Now, we've done this a few different ways for these longer term projects now, how we can apply, in other words, this percentage kind of allocation. One practice problem we did a couple problems ago on these capital budgets would be a situation where we think, for example, we have one piece of equipment that we're putting out up front, and then we think that it's going to have 5 years return or some set amount of years of return where the inflows will be the same for each year. In that case, what we did is we used our statistical kind of category analysis to figure out what we believe the cash flow might be under different kind of scenarios, different kind of projections, and then we got our expected value based on that we then apply the net present value calculation to. That's one way you can then work this thought process into the capital budgeting decision. We also thought about a situation where it might be somewhat more complex of a situation where you do not have even cash flows. And one way you could still work in this thought process is possibly to then work out each of the 3 scenarios that you might take for the entire life of the capital project under 3 different scenarios, allowing you a lot more diversification, and then take those net present values and then allocate them into our kind of thought process here to get our expected net present value. That's another method that can be used. This is the third method that we're using that we can apply to this cash flow or budgeting type of process. In this case, we might say, let's take one capital budgeting process. And remember, the assumptions that we typically make with a capital budgeting process in order to figure out the net present value are what's going to be the initial outflow. That's something that's usually given. That we know that. We can kind of figure that to a pretty high degree of accuracy. But we don't know the inflows. That's, of course, a projection into the future. And if you're talking about more complex types of projects that are happening in the future, the inflows that are coming back are really just a guess. And they could be substantially different from year 1, year 2, year 3. If you're talking 3 years out, it could be substantially different what's going to happen in year 5 versus year 1. And so therefore you might try to apply this kind of statistical kind of concept per year to try to think about how much your actual cash flows will be for each of the years to come up with different cash flows basically each year and then apply your net present value. So that's going to be this method we'll take a look at here. So for example, here we're going to add it even a little bit more difficult, a little bit more complicated, in that we're not going to have cash flows coming back each year. So we're going to get cash flows coming back after 1 year, and then we're going to say after 3 years and after 9 years, just to add a little bit more of a complexity in it. But just realize, even if you got cash flows back every year, you can apply the same kind of concept, and it might be applicable to do so if it's complex in terms of how much money you're going to get back each year. So we might say for year 1, for example, we could say low, average, high. Remember that the number of categories don't really matter. The names don't really matter. The numbers matter. but usually it's about 1 to 5 categories. And then we'll apply how much we might get if it was low, average, or high based on past experience and our projections into the future. If it was low, we're saying 300 for year 1, average 800, high 1,000. Then we'll apply our percentages. This is our best guess again to try to think about how likely it would be for these outcomes to come into play. So the low is going to be the 40%, average 20, and high at the 40. Those percents have to add up, of course, to 100%. 300 times the 40% is 120. 800 times the 20% is 160. 1,000 times the 40% is 400. The 120, the 160, the 400, that adds up to the 680. So the expected value of year 1 of this extended project, we're going to say, is the 680. Then, of course, as we do the net present value, we can use that number to do our discounting back to the net present value when we do our net present value, which we will see shortly. And then we're going to say there was no income in year 2. We're going to project that it's an unusual stream of income coming back, right? And then in year 3, we're going to get income. We're saying low, average, high. So we're thinking 500, 800, and 1,200 percents, the 30, 40, 30 on the percents. So the 500 times the 30%, 150, 800 times the 40% is going to be the 320. The 1,200 times the 30% is going to be the 360. The percents, of course, add up to 100%, and then the totals now add up to the 830. So for year 3 now, we're guessing then we have an expected value. Our best guess based on this type of analysis is 830 for the expected value there, which once again we can present value or use that as part of our present value calculation. And then year 9, once again, we're assuming that it's a weird cash flow situation. We're not getting any more cash flow back until year 9, where we have then low, average, high, 400, 800, and 900, 40, 20, 40 on the breakout. So 400 times 40, 160, 800 times 20, 160, and then the 900 times the 40, or the 360. The totals adding up to 100% on the percentage. That gives us the 680. So the one that's at 9 years out, we think that the value that we're expecting to receive is the 980. So once we have that, once we've analyzed all the cash inflows basically on a one-by-one process using this analysis, then we can use that to do our net present value type of calculation. Before we do, note we're going to do the other kind of statistical for the coefficient of variation here. So the coefficient of variation calculation for the 3 of them, just to practice with that as well. You can do that basically on a year-by-year basis, and that can give you some more detail if you were to compare these, and it also just gives us good practice to work through these type of problems. So we're going to say for year 1, if we had our same returns here, the 300, the 800, the 1,000, and I'll go through this a little bit more quickly because we have seen these in the past. The expected value or average is going to be the 680, the 680, the 680 that we calculated up top. The difference, the 300 minus the 680 is a negative 380. 800 minus 680 is the 120. 1,000 minus 680 is the 320. Then we square these items. And if you want to see this more slowly going through, you can take a look at some prior presentations where we spend a little bit more time on these. We'll just do them a little bit faster here. We got the 380 negative squared is the 144.4. 120 squared is the 14.4. 320 squared is going to be the 102.4. Probabilities then are the next item. That's going to be the 40, 20, 40. The 144.4 times the 40% is the 57,760. The 14.4 times the 20% is the 2,880. And the 102.4 times the 40%, 40,960. Adding up the outer column gives us the variance of the 101,600. Then we would take the square root of that to get the standard deviation, 318,775. Then we divide by the expected value, which is the number we calculated up top, 318.75 divided by the 680 gives us the coefficient of variation, the 0.469. Let's do it then for the year 3. We have then the return up top, the 500, the 800, the 1,002 expected values calculated at the 830. The differences then here, 500 minus the 380, the negative 330, 800 minus the 830, the negative 30, 1,200 minus the 830, the 370. We square those, negative 330 squared, 108,900, negative 30 squared, 900, the 370 squared, 137,900. Applying then the probabilities at the 30, 40, 30, 30, 40, 30 gives us then are 1089 times 30%, 32,670, 900 times 40%, the 360, 136.9 times the 30%, the 4170. Adding those up gives us the variance, the 74,100. Taking the square root, standard deviation, 272.21. Comparing that, dividing by the 830, which is the expected value, average, or mean, gives us the coefficient of variation 0.328. One more time for year 9, we're going to say the return. The returns are the 400, the 800, the 900, 489. The expected value we calculated at the 680. The difference, the 400 minus the 680, negative 280. The 800 minus the 680, the 120. The 900 minus the 680, the 220. The negative 280 squared, 78.4. 120 squared, 14.4. 220 squared, 48.4. Probabilities then, 40, 20, 40, 40, 20, 40. The 78,400 times the 40% gives the 31,360. The 14.4 times the 20% gives the 2,880. The 48,400 times the 40% gives the 19,360. Adding those up gives us the variance, the 53,600. Standard deviation, square root of that, the 231.52. Then we take that compared to the expected value divided by, in other words, the expected value of the 680 to get the coefficient of variation, the 0.340. So now we'll go to the kind of the new thing here, which is to do the present value calculation. So you'll recall we had the expected value in year 1, the 680, and then the 830, and that was in year 3, and then in year 9 we had the 680. And so we could do this in 2 different ways. We can do it the easy way, where we're not going to have every year because some years we didn't have cash inflows, or we can list off all the inflows here. So let's do it the short way first. So the way I would basically set this up in Excel is to set our table from periods 0, and usually I would go 0 down to how many years there are, but now I'm only going to include the years that have activity in them. So year 0, 1, 3, and 9. These are going to be important because I'm going to use them as cell references if I was to calculate these using Excel. The first period 0 was the outflow, which we're saying was 1,400. Then we'll apply the present value. The present value calculation to the outflow that happened at period 0 then will have no impact, meaning the amount will be the same, but in Excel we can copy that down. Also note that if you want to know how to do these present value calculations multiple ways, like with a table or with formulas, take a look at some prior sections where we spend more time in on that. We'll do that more quickly here, just referencing to how we would do it in Excel. So we'd say in Excel, we'd say the negative present value, the rate I'm picking up this cell, the 15, it's going to be absolute reference by a $sign before the C and the 8. So if I copy it down, I can copy it down easily and not have that cell reference move, comma. And then we have the number of periods, which is 0. Instead of typing it in there, I'm referring to this cell. So once again, it will copy down for us and make our life easier, comma, comma. And then we have the future value, which is that 1,400. The result is the same because we're at period 0. And then at period 1, if we copied this down, we would take the 680 and take that back for 1 year. Let's just get rid of all these. We see that's going to be the period 1 and period 3. We're going to bring that back 1 year. So the negative present value is going to be the rate, same cell here, which is that 15% absolute reference, comma, number of periods, which is now going to be 1. So it's picking up this 1 here. Instead of hard coding it, the cell reference goes down from M2 to M3, and then comma, comma, future values at 680. So we discount it back, giving us the 591. Now, if I copied this cell reference down, you'll note that this cell right here, which represents the number of periods, would copy down from this 1 to 3, because we skipped period 2. So that's how this column is helpful over here. So in other words, if we discounted the 830, which we got from this reference, this calculation, our expected value is this 830, and we discount it back 3 years using the discount rate of the 15%, we get the 546. And then year 9, we're saying nothing happened until year 9, where we had the expected value of the 680. So now we're going to take the year 9, the year 3, but was the 830. Year 3 was the 830 discounted back 3 years at 15% gives us 546. Year 9 is the 680, which we're going to discount back 9 years at 15% to give us the 193. Then if we sum these up, we get a negative 70. That means we haven't cleared the hurdle rate or the discount rate, so we might not take on the project based on that because we haven't cleared the 15%. If it was 0 or above, you'll recall that might be something that we would then take on. That's the general rule for the net present value. Now, you could set up the table that looks like this as well. You might just have years 1 through 9, even though many years are 0, and say at period 0, we have the 1,400 negative outflow, and then the 680 period 1, that's from our expected value. Nothing happened in year 2. Year 3, the 830, that came from our expected calculation over here. Nothing happens from 4 to 8. And then period 9, we have the 680. And then we can simply copy down. This would be more tedious to do if we were to do this in a book problem because it take more calculations if, take longer to list this out. But if you do it in Excel, really easy to do. You'd have the same formula up top, and then you could simply copy that formula down, and it would be fine. If it was 0, it would be fine, and you can calculate this quite easily. And you might be able to show people pictorially. It might make it a little bit more clear about kind of the strangeness of the project, right? To show that we have all these years that we expect no inflows that are going to be happening, and the inflows on 1 year out, 3 years out, and the 9 years out. Same result though. We got 1 year out. We discount the 680 back 1 year at the 15% to get the 591. The one that for 3 years out was the 830. We're going to discount it back for 3 years at the 15% to get the 546, and the 680 at 9 years back that we calculate 9 years back at the 15% for the 193 to total up to that 70 negative, once again below 0, therefore not taking into consideration or not clearing the 15% rate. And so we may not take on the project in that case. So as we go through the different kind of ways and angles you can look at these projected problems, hopefully you get some idea of the complexity that goes into the decision making that would be involved as you're kind of projecting out into the future to make these decisions. There's no set process because it's not a done thing. We're using the best tools we can in order to make predictions about the future and the best decisions we can.